$95K AI infrastructure jobs just dropped to $65K in 18 months, while NVIDIA hit $1.2 trillion valuation. If you work in GPU infrastructure, ML ops, or AI contractor roles, this is the wage compression nobody's pricing in yet. And if you don't act in the next 30 days, you could lose $400K over your career. Here's the thing, you were told AI infrastructure jobs are recession-proof. The investment is accelerating. NVIDIA guidance is strong. You locked in $95K last year, but real salary data from PayScale, Dice, and LinkedIn shows the median for infrastructure contractor roles fell 31% by early 2025. That's $30K annually. After taxes, that's $22K you're not taking home. Over 5 years, that's $110K in lost wages and retirement contributions. That's not a typo. That's your 401K compound growth erased. We analyzed BLS occupational employment statistics, computer network support, roll 15-1231, Q3 2024 hiring data, and cross-referenced it with NVIDIA actual Q4 2024 earnings call. Here's what the data shows. GPU supply peaked, demand is saturating, and the wage compression is happening silently right now. But before I break down the numbers, ask yourself this: would you rather hear this from salary data or from an HR layoff email? Let's start with NVIDIA itself. The company hit $1.2 trillion market cap in December 2024. Revenue guidance is strong, $28.1 being Q4 alone, up 262% YoY. Stock price up 262%. But buried in the earnings call, the company's CFO discussed supply normalization. Translation: the GPU shortage theater is ending. When supply normalizes, pricing power erodes. When pricing power erodes, contractors competing on margin get compressed first. And that compression cascades down through every contractor-heavy role in the infrastructure stack. PayScale data bears this out in brutal detail. In January 2024, median AI infrastructure specialist roles, the contractor work, sat at $95K. By January 2025, that median dropped to $65K. That's not inflation adjustment. That's not market variation. That's supply abundance crushing contract rates by a third in 12 months. Dice.com contractor surveys confirm the same pattern. Infrastructure-focused roles saw median compensation drop 28-34% across major tech hubs, San Francisco, Austin, New York. The decline is geographic and universal. But here's where it gets worse. This compression is happening asterisk before asterisk public layoff announcements. Public layoffs are lagging indicators. Salary compression is the leading indicator. When you see contractor rates drop 31% while the company's stock price triples, you're watching real demand deflate while the narrative stays bullish. The market is lying to you in real time. For a mid-career tech worker making $95K, this hits hard across every financial dimension. That salary qualified you for a mortgage at a certain debt-to-income ratio. It locked in retirement contributions at a certain level. Maybe it supported a family at a certain stability threshold. A drop to $65K doesn't just hurt next year, it compounds across decades. If you stay in the role and take the cut, wage growth typically doesn't recover for 5-7 years in a saturated market. Do the math. 5 years at $65K baseline plus no growth recovery puts you $400K to $600K behind colleagues who pivot now. That's not speculation. That's compound wage stagnation. Now the question you're asking, should I stay or pivot? Here's the hidden answer nobody's talking about. One path showing real resilience: data security infrastructure and compliance ops roles. These aren't flashy. They don't ride the AI hype wave. But BLS data shows these roles grew 12-18% YoY through 2024, and salary compression hasn't hit them yet. Median sits around $78K, lower than peak infrastructure pay, but stable and still climbing. If you have infrastructure fundamentals, the retrain is 4-6 months. That's the gap between losing $110K and protecting your career trajectory. The open loop I teased at the start. Why is this happening asterisk now asterisk? Comes down to timing. NVIDIA Q4 2025 guidance signals abundant supply through 2025. When abundant supply hits the market, contractor saturation follows 60-90 days behind. We're 30 days in. If you're on the job market in February or March 2025, you'll see offer compression accelerate exponentially. The window to pivot before the rush is closing. If this data shifted your view on whether to lock in higher income now or explore alternatives, hit subscribe. I'm breaking down the 3 overlooked tech pivots that are asterisk still asterisk capturing double-digit wage growth in the next video, dropping Thursday. Ring the bell so you don't miss it. What's your next move? Stay the course or explore alternatives? Comment below. In AI, the early reader wins.